I want to talk about an exciting new UK ETF that provides value, income, and fingers crossed capital growth. In the past, UK investors haven't really done that well, and part of the reason is that major players in America, whenever they try and buy UK companies, they end up getting their fingers burnt, just like Warren Buffett here with Tesco. So although UK shares potentially offer good value, they still seem to flummox some of the world's best investors in terms of providing decent investing opportunities. This is particularly true for ETFs that focus on dividends. And here we've got a 5-year chart of two UK dividend focused ETFs, iShares UK Dividend that's returned 10% over 5 years, but that includes all of the dividend income, and WisdomTree UK Equity Income that's performed even worse with returns of only just over 1%. So going forwards, we need to try and improve on these returns and get some decent dividends, but then also some capital growth to balance that out. So the reason why iShares UK Dividends has underperformed has been for two reasons. The first is that companies paying high dividends aren't investing enough cash back into their business to grow, so such high dividend payers are often losing market share and not really retaining their status on the global stage. And then finally, the dividend criteria is backward looking, so it's looking at what happened in the past, and as we know, that's not necessarily a good way to evaluate what might happen in the future. The solution to all this is to innovate more in the ETF space, so to look at multiple factors, so not just quality or dividends, but to have a lot of screening criteria to find the best candidates for a fund. And in this space, WisdomTree are a leading player, and they've just launched the WisdomTree UK Quality Dividend Growth ETF. So this is a physical ETF. It actually owns the shares. It has 75 to 100 holdings. The charges fee is 0.29%. The ticker is UGRW, and the launch of this UK variant takes WisdomTree's range of quality dividend growth ETFs to 4, with global, US and Europe being the other 3. And this whole range has now grown to $1.3 billion of assets managed since their launch in 2016. And here's the performance of the variance of the quality dividend ETF compared to the standard indices. So for the world, it's got 10% growth compared to 9.3. S&P 500, which is very difficult to beat, 11.7 versus 11.6, and Eurozone 8.4 versus 7.3. Although this is only part of the story, because the whole point of these ETFs is also to be more robust in market downturns, so you have less likely loss of capital as well as the potential for reasonable growth. Here are some reasons why WisdomTree are very keen on the quality factor. They think that it has good long-term historical outperformance. They think it's a recognized investment philosophy. They think it can balance risk in terms of upside capture and then very limited downside capture. So I think it's got a lot of resilience. They think you can protect the margins of the business through having a quality operation, and they think it's defensive during economic downturns. And the combination of all this, they think, is why quality is the main factor that they want to focus on. The portfolio for the ETF is constructed firstly around companies that pay dividends. They also have to be larger than $200 million market cap. They have to meet the ESG criteria for WisdomTree. They also have to meet a low risk requirement, which is a mix of momentum and quality metrics that get applied. The weighting for each stock in the portfolio is then derived from the amount of dividends that the company pays. And this methodology takes into account the size of the company, but then it also avoids focusing on some companies that are very large but have a low dividend yield, and it avoids some stocks. Companies with a low risk score are excluded from the fund, and also companies that are ranked within the top 5% by dividend yield and the bottom 50% on the risk factor being price momentum and the quality factor are also excluded from the ETF. So a lot of the high yielding companies will end up being excluded. So here's the top 10 holdings of WisdomTree UK Quality Dividend Growth compared to the iShares IUKD. And for the WisdomTree, we've got some really good names here like AstraZeneca at number 1, Diageo as well. Whereas within IUKD, we've got HSBC, British American Tobacco, Legal & General, and these are all actually excluded from the WisdomTree ETF. It's also excluded BP and Shell, possibly on ESG grounds. And then the top holdings of the WisdomTree ETF are capped at this 4.62%. So here's the sector exposure of the WisdomTree ETF versus the FTSE 100 and the FTSE All Share. And we notice that industrials are overweight, energy very heavily underweighted, real estate underweighted, technology has an overweight, as does consumer discretionary and communication services. So overall, it's a slightly more favorable sector mix, I think, that I want to hold within a stable and solid UK ETF. Here are some fundamental metrics of the WisdomTree UK Quality Dividend Growth ETF compared to the FTSE 100. So there's a lot higher return on assets and return on equity. So profitability stats are very strong. Price to book ratio is about double that of the FTSE 100. So you are kind of paying for this extra returns. Price to earnings is pretty much in line with the FTSE 100 and still pretty good value at 10.4. And then the dividend yield is slightly below FTSE 100, 3.5. but still seems fairly reasonable. It'll give you some sort of income if you're later on in life. One of the great things about ETFs is that you can download on a daily basis the holdings in the ETF and their weightings within the fund. So you can know exactly what the ETF is holding, and it's a great way of tracking what's going on, along with the fact that you can track the PE ratio every month in the fact sheet. So that way, the ETF gives you a lot of confidence in terms of what you're holding and when it becomes overpriced and when it might be better off for you to consider something else. So the WisdomTree UK Quality Dividend Growth ETF is new. It's only just been released, but I think that it has a fairly solid portfolio. The fees are pretty reasonable. And because you don't have this manager risk, then I think hopefully over the longer term, it can be a good addition to a portfolio. And it's well worth keeping an eye on these smart beta ETFs and how they perform and the innovation that's going on, because I think this is an area that deserves a lot more scrutiny. So one possible investment trust alternative to this ETF would be the one coming on from JP Morgan, where they're merging JP Morgan Mid Cap with the JP Morgan UK Smaller Companies Investment Trust, and the combined entity will then pay a dividend equivalent to 4% of net asset value. So it will mimic the strategy of the mighty JGGI, and possibly the best ideas across the small and mid cap segments from JP Morgan will be able to deliver some solid companies with some decent growth that could potentially benefit from a rebound in UK stock market valuations, whilst paying you a 4% dividend yield while you're waiting for the value to become uncovered. Hope you enjoyed the video. If you want to look at the WisdomTree Global Quality Dividend Growth ETF, then I recommend you watch this video next.